Welcome to Fidelity Soundbites, a monthly podcast where investors can tap into Fidelity's more than 400 investment experts who are on the ground around the world so that you have the inside edge when it comes to making more informed investment decisions. From equities to fixed income to private assets, let us help you build a better financial future.
Welcome to Soundbites. I'm your host, Lukasz de Pourbaix, and I'm pleased to be joined today by Maroun Younes, co-portfolio manager for the Global Future Leaders Fund. Welcome, Maroun.
Hey, it's good to be back. Thank you.
And today we've got a very interesting discussion. So AI is no doubt very topical. It's in the papers every day in terms of a theme. And recently we actually had a discussion around this theme in an event we recently hosted talking about sort of navigating the AI boom. So if you sort of take that theme and we sort of explore it a little bit further, I'm really interested in sort of understanding, stepping back a little bit in terms of bubbles, because one of the things that constantly comes up is this AI theme is so strong, the returns have been exceptional, but are we in a bubble? Take us back and maybe sort of step through what typically characterizes a bubble and what are some examples of previous bubbles we've gone through in markets?
Yeah, so, I mean, what characterizes a bubble typically is where the narrative takes over. So it becomes less about the fundamentals, it becomes less about what the businesses are doing, but it's more about the hope and the narrative of the future. And it gets driven a lot by sentiment. So part of it is fear of missing out. Mm-hmm. Again, part of it is driven by the narratives about, these businesses are going to dominate the future, for example. And then ultimately what you get is really prices detaching from reality or detaching from the fundamentals. Mm-hmm. And it becomes less about what you can justify given the current state of the businesses, and it's more about, what these businesses may or may not deliver in the future. Mm-hmm. So that would be, I guess, a broad way to characterize a bubble. In terms of some of the more notable ones, obviously, the first one that we sort of have recorded is the tulip bubble back in the Netherlands, yes, 400 years ago.
That's right.
Some of the more notable ones, I guess, in the last 100 years, there was a bubble in the 20s. Mm-hmm. A lot of that was driven by new technologies such as radio. Mm-hmm. We obviously had the dot-com bubble. That was a big one. There's been a few other more regional ones, like Japan, for example, in the late 80s, Japanese real estate, Japanese asset prices. Mm-hmm. So they're probably some of the more notable ones. There's some smaller ones here and there. Crypto have gone through a few of them. Yeah, so that would be, I guess, the most notable ones.
As you say, there's some common sort of themes in all of those, isn't there? There's Absolutely. Sort of that exuberance. There's a famous book sort of, was it Robert Schiller, Irrational Exuberance, where he sort of talks about some of these thematics. There's sort of the media gets onto it, and there's sort of this sort of, relinquishing of risk as a thing, really. And,
Absolutely.
And it's all upside. So it is quite interesting. And I'm actually interested in your thoughts around, if you think about some of those characteristics, but if you think about also where we are today, some of the broader market structural things in the market, are you sort of also observing that the magnitude and the length of potential bubbles is elongating because of the market structure? So, common things that people are referencing is things like the growth of ETFs, passive investment, this almost sort of this feedback loop where the weight of money going into things elongates the potential for bubbles to go for longer and be more powerful. Is that something you're sort of observing as well, more generally, in terms of that dynamic?
Look, I haven't seen anything like empirically to say that. The points you raise definitely make sense. Mm-hmm. But I guess if you sort of do go back in time and look at some of the other bubbles historically, that they have tended to go on for years, in some cases, close to a decade. Yeah. The railroad boom, I forgot to mention that, but that was sort of in the mid-1800s. That sort of went on for like 10, 15 years. Mm-hmm. So it would be hard to say, I think, and prove empirically whether the bubbles are getting longer or shorter. But historically, if you sort of think about the conditions for the narrative to sort of take over, for people to get, sucked right into the vortex of it. Normally that's a process that takes quite a bit of time. Yeah. And, I don't think today would be any different. Yeah.
So now if we sort of relate it to where we are today, and as I mentioned in the opening, there is some debate as to whether this AI theme is a bubble waiting to happen, or is it actually a structural growth story that actually has fundamental legs? And the reality sometimes is a bit of both, right? But I guess if we sort of maybe put the sort of pro case, i.e. yes, it is a bubble, and maybe the negative case, i.e. it's not a bubble, it'd be interesting to explore some of that. So if I was to sort of propose that actually the AI theme is a bubble, like how would you sort of respond to that?
Well, the first thing I'd say is they're not mutually exclusive,
Yeah.
right? And most of the bubbles historically have been driven by something that's fundamentally changing the world. So again, railroads, it was changing the way passengers sort of move around the continent. It's changing the way freight moves. Radio changed fundamentally the way we communicate back in the 20s. The internet changed things, 20, 30 years ago. And AI will change things in the future. So I don't necessarily think the two have to be mutually exclusive. In terms of where it could be a bubble, I would say is certainly the amount of capex that's gone in a very short space of time. We rarely see this much capacity coming in a particular area. So that would potentially lend itself to an argument around the bubble. Also, the fact that today, as we stand, the revenue and returns that we're generating from all of this spend is yet to deliver anything meaningful. So if this were to persist, then certainly this would also lend itself to being a bubble. It's a bit early to tell on that one because the returns still may come through over time. The excitement, the hype, certainly the narrative is there. The duration in terms of how long out into the future investors and the market are looking. I think all of those softer factors certainly would be lending themselves to a pro-bubble argument. Yeah.
And if you're sort of to take the sort of view that actually, no, it's maybe not a bubble, but it is a structural story, what are some of the things in your mind that would be supportive of that case?
What would be supportive of that is the main players today, with the exception of OpenAI, the owner and maker of ChatGPT, more reasonable valuations they're currently trading at. So if you sort of think about .com bubble, it was characteristics for companies to be trading on 60, 70 times PE, sometimes not even making any earnings, just trading on a sales multiple. It's very, and it's fundamentally very different today because what you're seeing is, that, again, with the exception of OpenAI, the majority of the big names in the AI race are businesses that have been around for decades, established, very large, very cash generative, vastly profitable. This is very different to, say, the 90s, where any person could sort of raise, a few $100 million, have a company name with a .com on it, and then, list and off you go. The main players today, if you think about Amazon, you think about Microsoft, you think about Google or Alphabet, Meta, Oracle, these are businesses that have been around for 15, 20, 30 plus years, worth trillions of dollars, generating hundreds of billions of dollars in annual cash flow. And the majority of them are trading at 35 times or even less price to earnings. Very different again to a Cisco or a Sun Microsystems in 1999 that was trading predominantly on a sales revenue, hardly any profits, or astronomical 70, 80 times PE. The exception would be OpenAI, right? OpenAI, $500 billion valuation, probably doing right now 15 to 20 billion in annual revenues, probably a bit more on an annualized run rate, so probably more like 30 plus billion on annualized run rate, but certainly for 2025, 15 to 20 billion in revenues with $500 billion valuation, with capital spending commitments over the next 5 years in excess of $1 trillion. That one sort of stands out. But you look at Amazon, you look at Microsoft, I mean, they're reasonable valuations, and they've got a legacy, immensely profitable business. Fundamentally very different to what we've seen in the past.
No, absolutely. And it will be fascinating to see. I think OpenAI is looking to IPO at some stage. So that will be really interesting to see how the market reacts.
Yeah, absolutely.
When that happens. So if you from an investor perspective, and your day job is really sort of looking at the broad investment universe, working with our research team and trying to identify those quality names in a sector like this where it can be challenging because a lot of it, there's, as you say, if you think about that AI theme, it's like, what is the use case and how is that monetized over time? I mean, there's still some question marks over that. So how are you playing the theme? What are the types of things you're looking for? And, what are the typical characteristics you like to see when you're looking at a company that's either directly or indirectly linked to this AI theme?
Yeah, well, I mean, just for full disclosure, because we're in the sort of small and mid-cap segment, a lot of those names that I mentioned earlier in terms of the leaders in the AI race are beyond what we can look at, right? So because of our focus in a particular market cap spectrum, we end up looking more at indirect plays. The direct plays tend to be larger. It's more about scale of data and those sorts of things, right? So what I'm looking at is effectively indirect plays. And what I'm looking for is businesses, usually they're picks and shovels plays, and they will play a role in a particular niche in enabling some of these larger guys to do what they do. So whether it's, there's a few different examples in the portfolio today, but one, for example, is a leader in cooling technology. One is a leader in designing and installing HVAC systems, so heating, ventilation, and cooling. So the entire end-to-end process, because data centers they generate a lot of heat. And so cooling the data center, keeping it cool in an energy efficient way is actually quite an important thing. Another way that we have exposure is through utilities. Right now, one of the biggest bottlenecks for being able to build data centers is actually access to power. Access to power is actually right now more of a bottleneck than access to chips. And so we're seeing examples like Microsoft came out the other day and saying they've basically got a whole bunch of chips which they don't have power to. So they're just sitting there idle. And so that is a big constraint. And that won't solve itself easily in the next year or two, because if you sort of think about what's required, you need permits, planning, zoning, whether you want to build a nuclear power plant, whether you want to build, coal's not really getting built, but you might commission stuff that, was recently mothballed or earmarked to be decommissioned, and now you sort of bring it back online. All of these things, and you've got to refurbish them, bring them back up to modern standards, make them a bit more efficient. So all of these things, will take time. So whether it's greenfield or brownfield energy expansion, these things are not going to solve themselves in the next year or two. So that's probably going to persist for a number of years. So for those sorts of picks and shovels plays, they're less exposed directly to the return of AI. They're more exposed to the hyperscalers continuing to race amongst themselves. Now, obviously, if the returns don't come through, those hyperscalers will eventually dial back their capex spend, and that'll impact the picks and shovels plays. But for the time being, and for what we can see in terms of all the comments that the likes of Microsoft and Amazon, et cetera, are making about their future spending plans, these picks and shovels plays have 12, 18, 24 months of good visibility backlog into future work coming through the pipeline.
So it's an interesting sort of a point, because I think, one of the interesting things a lot of investors are thinking about generally is the AI theme. And yes, it's done really well, but generally most investors will have a big exposure to that theme, whether they're invested in an index or in an active strategy in that large cap part of the market. Inherently, they're going to have a reasonable exposure to that theme in some shape or form. Now, if we do see a pullback in that theme, and generally, that would certainly impact the broader market. So if you think about the S&P 500, it's a big component of that
40%.
40%, right? So the mid-cap and small-cap part of the market, which you invest in, how would you envisage that if we were to hypothetically see a pullback, and the fact that you aren't investing directly in those big names, you are sort of investing in those picks and shovels, as you say, what would be your expectations if we did see a bit of a pullback in that part of the market?
It's a very interesting question, because if you look historically, the majority of market corrections tend to be led by SMIDs on the way down. They tend to be more cyclically exposed. They tend to be, in aggregate, less resilient businesses and higher beta. So normally when the general economy starts to roll over, they're one of the bellwethers in terms of rolling over first, right? And you see a flight to quality up the market cap spectrum. This is very unique because this boom has not been led by, but also the boom is usually led by SMIDs as well, right? This boom is not led by SMIDs. It's actually led by the mega cap end of town. And your question is specifically not around the general market recession, but an AI-led correction. So that one, I'm not sure if the SMIDs would lead on the way down. It may actually be the mega cap names if it's purely around skepticism or pessimism around what AI means for investors. I think you would actually see something different where it'd be potentially led by the mega cap end of town. And then it would have contagion effects into the broader market because, it's 40% of the S&P 500. So the market in aggregate is almost certainly going to fall. We've never seen such a large concentration exposed to a handful of names. So they would almost certainly lead the market down. Then you get some contagion effects because you get negative wealth effects. You get risk appetite coming, right down. People becoming very risk averse, taking money out of equities, putting it into things like cash, etc. So that would have a broader impact on the rest of the market, and the SMIDs would be no different. The best, I guess, analogy I could look at is probably in the dot-com bubble, where you actually had the NASDAQ peak in around March or April of 2000. The S&P 500, which had a lower tech weighting back then, and certainly a lot less than the NASDAQ, that didn't peak until around, I think, September, October. So actually for a few months there, you had this unusual thing where the NASDAQ was going down, the S&P 500 was still chugging along in an upward trajectory before it finally rolled over, because then you had a contagion and you actually had a general recession coming in. But certainly the reduction in the S&P 500 back then was a lot less than what we saw in the NASDAQ. Now, the S&P today is nowhere near as diversified as what it was back then. So it probably behaved more like the NASDAQ than what it did back then. But I think the SMIDs category certainly, you may see something similar. And also, if you think about valuations, the valuations in the SMID cap universe today is broadly in line with its long-term history. Whereas valuations in the S&P 500, the NASDAQ, the mega cap end of town are in their top decile of historical, the historical data that we have. So certainly there's more of a reason to be optimistic that SMIDs can hold up a little bit better, relatively speaking. They'll still fall in absolute terms, but certainly there's a lot of reason to believe that they won't fall by as much as what you may see in that top end of town.
It's really interesting because it to your point, it's a little bit counterintuitive, right?
It is.
But we saw maybe a little bit of that when we had that DeepSeek moment where obviously a couple of question marks were raised about the sort of business model of some of these large players.
That's right.
And actually some of the mid-cap part, the mid-cap part of the market actually held up better in that environment. So
that's right.
So there's certainly precedent for that. So then if we sort of look ahead, I guess you sort of alluded to a couple of companies and types of companies that you're sort of focusing on in that space. If you're looking ahead, where are you looking at other opportunities in that space? Are you sort of, or are you sort of comfortable with your exposure at the moment? Just interested in understanding where the opportunities lie. Specifically
with regards to AI exposure?
Correct, yeah.
So we're always on the lookout, but I think just given where we are in that AI cycle and the potential for it to manifest a little bit more into a bubble, what I'm particularly looking for is businesses that have some exposure that have not yet been swept up in the mania, because ideally what you want is a business where it's got a division or a small part of it exposed to AI that could actually record growth, but it's not really caught on by the broader market. Because right now what we're seeing is lots of stuff that are exposed to AI directly or indirectly, but the markets recognize that and they're trading at elevated valuation multiples, which means the downside risk should things spiral out of control is a lot more. So it's really trying to turn over as many rocks as possible in this space. Try and find businesses that the market is yet to sort of catch on in a big way, that actually these things are positively exposed to AI, and whether valuation makes sense, then sort of digging further into that.
So again, it's feels like it's a very much a bottom-up, stock by stock, company by company type of process. So look, thank you very much, Maroun. Thanks for your time. That's been really interesting, and we'll no doubt continue to talk about this theme because it's not going away.
No, absolutely. It's been my pleasure to be back, and this will unfold, over the coming months and years.
If you've enjoyed today's episode, make sure to subscribe to Soundbites on your favourite podcasting platform. Otherwise, if you'd like more information on Fidelity or Fidelity products, please head to our website at fidelity.com.au. Now for some important information. This podcast is issued by Phil Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation, or needs. You should consider the product disclosure statement and target market determinations for Fidelity Australia products at fidelity.com.au. Please click the link in the show's description to read the full disclaimer.